Let's get across the market open now. Kerry Craig joining us from JP Morgan. Kerry, great to have you back on the show. Thanks for joining us again. Let's start in the States. More records, particularly for the S&P and for the Nasdaq. What are you seeing? What's actually driving that at the moment?
Good morning, Andrew. I mean, the market has come off a little bit this week, but I think the one main feature is the fact that we're seeing the market continue to grind higher despite all these concerns around looming tariff risks on the 1st of August, some of the concerns around what the fiscal side of things may mean in both the short and the long term. And I think what's really underpinning that is both the avoidance of that recession and also the idea that some of these tariff announcements may be delayed or actually not come to bear in the form they currently are. And on the back of that, you've had earnings numbers coming out of the US, which have actually been quite strong, given the expectations were quite low heading into the current earnings season. So I think the underpinning of that earnings backdrop, the economic outlook, which is still relatively positive, is helping the markets move higher, which does seem to be the path of least resistance for now.
Yeah, I see your point to the tough environment, TUF standing for tariffs, unintended consequences and fiscal support.
That's right. I think the headwinds there, obviously from the tariffs and thinking about what they actually mean to both the economy and corporate world when it comes to America. Obviously, we're seeing some implications of that and some of the financials that are coming through. But by and large, it does appear that companies are thinking about how they can actually deal with it, especially the large cap companies, which maybe have better plans in place to be able to mitigate some of the effect of those tariffs or, some of the pricing power to pass on those to consumers. Whereas, smaller caps, more rate sensitive parts of the market perhaps are going to feel that impact a little bit more. And then there's the unintended consequences of that, obviously thinking about both the drag on growth, given that tariffs are effectively a tax on the economy and consumption, and also the inflationary consequences, which, we are still waiting to see in full force in the inflation numbers in the US, even if we are seeing just last month a slight tick up in that inflation number. And then offsetting that, obviously, is the fiscal side of things, where we do think about some of the household and consumer tax breaks that will come through. The fact that a lot of that was backdated to the start of the year should see those tax numbers when they do come through in 2026, payments back to households for tax they've overpaid, leading to a bit of a consumption pickup in the early part of 2026. But again, fading off, it is going to be a short-term sugar hit. And then in the background, the market being a little bit concerned around both the size of the deficit and the debt level in the US and thinking about the sustainability of that in the long run. So that creates this environment where we're very conscious of the risks that are out there, but also the fact that you have both these pull and push forces acting on markets and investor sentiment at the moment, which is creating this, what we classify quite a tough environment.
So given that environment you're speaking of there, Kerry, what are you watching for during earnings season out of the States?
I think definitely thinking about how companies are mitigating or thinking about how they're going to act against some of the tariffs, where there's any indication of passing on those costs. Our estimate is that around about 60% or a little bit more of those increased costs we passed on to the end consumer. Thinking about how they're dealing with that. The benefits are coming through from offshore earners in terms of the fall we've seen in the US dollar, which has been quite material over the course of this year, down about 10%, how that can boost earnings. And again, just how they're mitigating or at least navigating some of the uncertain political environment in terms of what they're willing to forecast or at least provide guidance on in this environment. So tariffs are still very much dominating the narrative, as well as the expectations around deregulation and some of the policy changes coming through. And we're also looking for any sort of signs around pockets of consumer weakness. Now, I've only had about 20% of the US market cap report so far. It has been dominated by a lot of the banks, which had better numbers, trading numbers based on the high volatility in the market. But, as we start to see some of those industrial companies start to report, some of the consumer names start to report, I think that's what we'll be looking for, any real risks or cracks coming through on the consumer side, given they're such an important part of the US economy.
Now, Kerry, it looks as though a trade deal between the US and the EU is not going to be forthcoming before that August 1st deadline. Raises that prospect potentially that transatlantic trade could collapse, or at least obviously there'd be a huge impact there. What are the likely implications, I guess, particularly for European equities?
I mean, yeah, European equities have been a very strong performer this year. If you look at the performance of, say, aerospace and defense, or even European banks over the last couple of years, since, say, the end of 2022, when the rally really kicked off, they've actually outperformed US growth stocks. So there's been a strong gain there, a lot of momentum behind those. Obviously, defense stocks coming back to some of the geopolitical concerns, the amount of money that's been put from Europe into defense security and thinking about that, as well as the infrastructure spend coming from Germany, for example, and then the banks reacting to what has been an improvement in the economy, and again, probably a little bit more of a cyclical pickup that we've seen in Europe. However, broadening out, we've seen the unemployment rate still relatively low. We're seeing high level of consumer savings, which could boost growth continuing going forward. The trouble is we obviously do think about the impact of these tariffs and some of the numbers that are being bandied around in terms of how high these tariffs could be, and they're much higher than the 10% baseline that the US has announced. So for us, it's very much a case of thinking about the European equity market still likely to be a beneficiary of some of the momentum, some of that capital flow away from the US as we think about that rebalancing of portfolios that are coming through, and still quite a fundamentally strong position given the valuation argument very much in favor of European relative to US equities. And earnings numbers, if we look at, say, what we expect for 2025, still mid to high single digits, which is not too different to what we're seeing in the US market. So getting roughly the same earnings, a little bit of a discount on the price, even if it has moved up over the course of this year, we do think supports the European equity market. But given there has been a strong rally in a couple of sectors and industries, I think it's very much a case of thinking about an active approach to Europe and thinking much more around some of the cyclical pickup that we could see there relative to some of the strong run we've seen in the defensive parts of the names.
And Kerry, what are your observations with the local market? Near those record highs, rallied on Friday, lost those gains yesterday. Looks as though we're going to open higher today. And also, we're going to be taking a look at those RBA minutes, perhaps as clues as to what the RBA is going to do next.
Yeah, I think the equity market here has been remarkable in the rally we've seen over the course of the last fiscal year. And it hasn't been as narrow as expected. I mean, there has been obviously a couple of very strong performers in some of the banks, but if you look across the market, it's about 15% of the market is actually, or sorry, half the market has gone up more than 15% over the course of the last fiscal year. So it's been a little bit broader than expected. I do think you're seeing somewhat of a rotation away from the very highly valued part of the market in terms of the banks. Obviously concerns around those valuations. And when you break it down and look at the composition of the market, it is very much that the financials are trading at a relatively high multiple. The industrials ex-financials are also trading at a relatively high multiple, given some of the numbers around tech stocks and some of the healthcare names. And then the resources and material sector obviously lagging when it comes to that valuation story. So you could see that rotation come further, especially if we see potentially more rumors and announcements coming out of China, because they do need to do more to offset some of this deflationary impulse that we are seeing in the economy. But I think the valuation argument on the whole for the Australian market is, again, a reason to look globally, and especially given the earnings numbers that we're expecting to see for the current earnings season and this fiscal year. It could be another third year of a negative earnings growth coming out. And it's not really backing up what we're seeing in terms of the valuation re-rating that's happened across the course of this year. So I think it's a case of being a little bit more defensive and growth orientated when it comes to the Australian market, rather than being cyclical, probably focusing a little bit more on names in the healthcare space, some of the IT space, as well as thinking about the potential for a little bit more re-rating in some of the materials and mining name, and being cautious around some of the valuations that are coming through on the financial side. And given the earnings numbers are a little bit lower here, and we're going to get more of that as we enter the August earnings season, it does appeal that you could see further rotation within the Australian market, given those valuation numbers.